Hi there everybody, and welcome back to another stock analysis video, the second one for today, where we're actually going to be analyzing a new company that we have yet to analyze in this channel. And this is actually brought up by a commenter, which he actually commented in my community post. If you guys haven't checked those out, make sure you check it out. And he pretty much just said FM, which I'm sorry, I'm too old, I'm 26 and I don't know what FM means. I did place Magnite a few weeks ago in my tech watch list. So you know what? I looked at Magnite and then I realized that they actually do have earnings, guys, tomorrow, or essentially today, right? And I figured, let's analyze it. Let's see if we can actually help you out and make a decision whether or not you may want to buy this company. So with that said, let's get started with this analysis. We are going to come into the calculator, guys. This company does not have a dividend, which is actually a good thing, especially looking at that market cap. Ticker symbol of MGNI. Market cap of $1.22 billion with a PE, guys, of NA. Yikes. That is not good. Usually companies that have a PE of NA, well, discounted free cash flow does not work, and discounted free cash flow does not work for this one. And I'll show you guys the numbers that the calculator is showing without me inputting any assumptions at all. You're gonna be like, that's insane, and it's because of just one little tiny number that's causing it to just go completely insane. So we're gonna be using book value and tangible book value to make further analysis on whether or not we should buy it at the current share price of $9.32. Now guys, something I also would like to point out when it comes to this company is that it has been for a complete roller coaster, and I mean that literally. If we take a look at the graph, guys, for the 1 year of MGNI, we can see that on the 1 year they are down 71.68%. Oh dear Lord. On the year to date, they are down 47.73%. Guys, that is absolutely insane. Looking at the 52-week range, we can see that they were as high as $34.26. And in fact, if we take a look at this graph right here on the 5-year, actually coming over here to the advanced chart, just so that way we can make it a little bit easier, you could see that this was one of the hype stocks. If you ever guys see this in like the 5-year graph for a company, you can see this in like Palantir, Peloton, this one, right? If you see something like this, like a massive run up and then just a massive crash down, this was actually part of the hype companies that was happening in 2020 and 2021. So unfortunately, it has come down by a significant amount. And if you bought, guys, at around this one, $61, that is insane. I know that the 52-week range said less than this, but this was on the 5-year. Look at this, guys, $61.68. I am so terribly sorry if you bought this company at this point thinking that it was going to continue to go up. If you did, and well, you're still in it, you are probably down a significant amount. So unfortunately, I really do feel empathy for you because I have been through this, but hopefully I can give all of you, I guess, solace and just maybe like a way out, hopefully, with this video. Now, as I said, they do not pay out a dividend, which thank God they don't, which means that all of their cash flow is going straight into themselves to grow the company, which they absolutely should be doing. Now let's come over here, guys, and do some analysis on the fundamentals. Starting, of course, with the net income 5 years ago of negative $155 million to 1 year ago, guys, of 10 cents. I would think this is what, $100,000, I would think. Yeah, guys, this is a massive increase of 100%. And y'all are thinking, wow, that's actually really good. Yeah, you guys are looking at this graph, right? 5 years ago, negative. 4 years ago, negative. 3 years ago, a little bit higher, but negative still. 2 years ago during COVID, more negative than 3 years ago. And then only last year's when they barely just became positive. And by the way, this value right here is the reason why the discounted free cash flow calculator does not work. If you guys want to see exactly what I mean, if we take a look at the free cash flow to equity divided by the net income on that one, guys, we get that percent. Yeah. That percent is essentially skewing everything completely out of control when it comes to this company. And let me actually show all of you guys exactly what I mean by that. If we come over here, we can see that the target share prices are $1,734. Yeah, this company is not worth that at all, right? Absolutely not, especially not with this kind of net income. So you know what? I'm going to give it a 10% just because of the fact that, well, it is increasing, I guess you could say, but it's guys, it's a negative metric. I mean, let's just face it, it's absolutely negative. Coming now to the free cash flow, the most important of all the profit metrics, because this is the one that a company uses to essentially grow, to make acquisitions, to buy back shares, and to pay down debts. And this company being this small, they do require a good amount of free cash flow, and unfortunately, well, they don't have a reputation for it. 5 years ago of $10.9 million to 1 year ago, guys, of $109 million. That is an increase of almost 1,100% with a 5-year average of $11.62 million. Now, this one, I guess, is a little bit better than the net income because you have 2 years of positive, and this 1 year ago is pretty high. But overall, guys, this is just negative, negative, positive, negative, positive. You know what, I'm gonna give this, guys, essentially like a 20%, just because 2 years of positive, but overall, guys, this is not good at all. And now looking at the revenue, we got 5 years ago of $155.5 million to 1 year ago of $468.4 million. That is an increase of 201%. That is incredible. But once again, we see something very, very weird. And that is that from 5 years ago to 4 years ago, they actually went down, guys. And then from 4 years ago to last year is when they actually did a significant amount of revenue. So, you know, I guess this one is a little bit better than the rest because, well, at least they're not negative. You have negative revenue, that's a really big problem. But I guess this one is a little bit better. Still nothing to, you know, be amazed about because it's not consistent at all, guys. So I'm actually going to give this at around like a 45%. Taking a look now at the balance sheet numbers of assets minus liabilities, which pretty much just tells us if the company is able to survive an economic downturn by hopefully their assets being higher than their liabilities. And as it stands, guys, this is the case at $837.9 million. And within the past 5 years, sure, they have been positive. However, it's been kind of iffy, and only 2 years ago is when they actually went up to $381.7 million. From 5 years ago to 3 years ago, they were essentially going downhill. Average total assets is around $1.2 billion, average liabilities around $803 million, and doing this difference, we get $416 million. Overall, guys, I actually have to give this an okay grade, I guess you could say. Not okay, right? But just okay as in like from what we have seen. I'm actually going to give this, guys, essentially like a 45%, just because it is increasing, I guess, but just because it is increasing and this is not in the negatives, which is okay. Now taking a look at the cash flow minus the liabilities. Just because the assets can cover their liabilities doesn't necessarily mean their cash flow can't. So if we take the cash flow year over year and the liabilities year over year and subtract them, we get this value. Essentially, what I'm looking for is this getting closer and closer to zero? And unfortunately, guys, it is not. It is getting way deep into the red, currently at negative $1.7 billion, and they've been increasing this within the past 5 years, or I guess decreasing it within the past 5 years. Average cash flow, we get $615 million in the red. So overall, I'm actually going to give this, guys, a fairly low score of around 30%. You're probably saying, why not lower? Well, it's because if you look at 5 to 3 years ago, they were essentially roughly the same, right? Kind of. It wasn't too bad, but then 2 years ago during COVID is when they really did amp up their liabilities. Last year is when they really went negative. And now the metric that I am dreading for sure. And well, guys, when it comes to companies that are rather new, don't pay out a dividend, they tend to issue a lot of shares, especially if their share price is at a whopping $60, which the company should not be worth. Essentially, the company is just like, yo, we don't issue any dividends. Our share price should not be worth this. Let's just issue shares. No hurt on us. Let's get that cash back to fund our operations. And unfortunately, that is a hurt on the investor. And as you can see here, this is a massive increase in their shares outstanding. However, it happened during 1 year, but they did continue it. 5 years ago of 49.7 million shares to today, guys, of 132.1 million shares. That is an increase of the 5 year of 165.8%. However, from the previous year to the current year, they are decreasing this at 0.08%. So this is looking at 1 year ago to today, 0.08. Guys, that's absolutely nothing compared to this mammoth of an increase on the 5 year ago, right? And this increase actually happened 2 years ago because of COVID. So understandable, but nonetheless, it is still an increase. And well, the following year, they continue to increase it as well. So overall, guys, I have to give this a really, really low score. It's a massive jump, right? It's a massive jump. So I'm going to give it a 10%. And lastly, when it comes to the cash equivalents, they currently hold $204.6 million with an average cash of around $133.12 million. So let's do a quick recap. Net income 10%, free cash flow 20%, revenue 45%, assets minus liabilities 45%, cash flow minus liabilities 30%, and the shares outstanding 10%. This comes out to be, guys, a total grade of 25%. So as it stands, when it comes to their fundamentals, they are failing and failing bad. But because I said that we can't use discounted free cash flow, we have to use, guys, book value per share. This can be found in Seeking Alpha, and the book value, it is essentially the company's assets on their books. You take that, you divide it by the shares outstanding, and you get the book value per share, and this is telling you how much the company should be worth today based on all of their assets that they have in their books. Currently, guys, this value is $6.35. 5 years ago, it was $3.31. That is up 92%. And now, while some people like the book value per share metric, others prefer the tangible book value per share. And this one essentially removes everything that is not tangible from the book value and only takes into account the tangible. And unfortunately, guys, this is in the negative $4.25. 5 years ago, they were at $2.79. That is a decrease, guys, on the 5 year, 252%. Now, the reason why I don't consider this accurate, I guess you could say, is that, well, Magnite, it is an ad company. They essentially sell ads, so they don't really have anything tangible, at least, you know, nothing too much. So I think that's the reason why we're getting this as a negative. So I think that the book value is a better representation of what this company should be worth. So if we actually take a look at now the price divided by this current book value, we can see that they're at 1.47. And what this means is that essentially the company is overpriced by 0.47 points. The closer to 1 this is, that means that the company is at value. Under 1, it is undervalued, and above 1, it is overvalued. So as it stands, guys, the company is overvalued by around 0.47 points. And on top of that, guys, just their fundamentals are not that good at all. So unfortunately, this to me isn't a buy right now. However, guys, just because this company doesn't use any assumptions when it comes to their share price, I still suggest that everybody should get this calculator. I have the book value one, as well as discounted free cash flow, a re-evaluation, and a dividend tracking sheet for everybody to have. All I'm asking for in return, guys, is like, subscribe, comment. Really does help me with the algorithm on YouTube. Thank you for the 800 people who have subscribed. I really do appreciate it. And you know, when it comes to companies like these, yeah, they are not that good, and this kind of analysis really does help you avoid, for example, a $62 price tag coming all the way down to around $9.32. So if we would have analyzed this when it was rising up, it would have been like, guys, this is not even worth it, don't do it, it's gonna collapse. Probably a lot of you would have been like, no, that's not true, you're missing out on the upside, it'll keep going up, and then crashing 73% or whatever, right? So I'm just trying to avoid as many losses as possible. That's my way of investing. Does that mean I'm going to miss on some opportunities? Sure. But the ones I get right, I'm pretty certain I'm going to get right. And as you can see right here, this helped me, so I'm giving this out for free. Hopefully that way it helps you guys too. All I'm asking for in return is to help me grow my channel. Hit that like, hit that subscribe, and of course, tell your friends to come and join this community. Overall, guys, when it comes to this company, it is a pass. Unfortunately, it is a pass. I don't like it. The fundamentals don't make any sense. It is just bad. Honestly, it's just a bad company. Sorry if you had your eyes on this one. Does it have potential? Sure, but I mean, their fundamentals just don't show it, and it's just way too risky for me. And they did come down, guys, 73%. That pretty much is it for this video. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube, as I said. You guys can follow me on my new tech sites, link in the description below. So with that said, peace out, and be on the lookout for the next stock analysis video.